All right, so in today's class, we will be continuing on life insurance and we will be continuing from chapter 3. Hopefully, we are able to get through chapter 4. And if we're able to take on some chapter by chapter quizzes to cover the chapter by chapter quizzes from chapter 1 through chapter 4. Great. Otherwise, we will just do chapter 3 to 4 and do the quizzes in a later class. So, on that note, let's dive into today's class and ride on with life insurance. And the topic before us, or rather, it's whole life. Okay, I'm trying to share my screen here. Give me one quick second. This page counter is blocking. There we go. Okay, got that. There we go. All right, just confirming that I'm recording. I don't want to leave anything to chances. Lovely. So we are continuing, and in chapter 3, we will be looking at whole life and term 100 life insurance. Okay, the concept of permanent insurance. Now, permanent life insurance is exactly what its name suggests. It's permanent. It provides insurance coverage over the lifetime of the life insured, and it doesn't end, or it comes to an end only upon the death of the life insured. Okay? It doesn't need to be renewed, it doesn't need to be converted. All the typical stuff that we learned yesterday regarding term insurance, all those does not apply to whole life or permanent insurance. However, permanent insurance differs from term insurance. Yes, absolutely. Term insurance is intended to provide protection against the risk that are temporary in nature. Got that? Now, insurance does not provide adequate protection against the risk of death due to expiration of the life policy. That's very true. Because you see, because term insurance expires, so if you don't have it active at the time of death, then to what end is the term insurance, right? Now, the fact that most insurance companies will not use a new term insurance policy to individuals beyond a certain age, of course, most insurance companies will not issue a new term insurance policy when somebody gets to age 75 or 80, right? And also, like level term insurance premium for permanent life insurance, the premiums are the same over the entire life of the policy. Just like a level term insurance, that the premium is the same over the period of the term. Same thing with permanent insurance. With permanent insurance, the premiums doesn't change. It's leveled, it's the same all through. And in the early years, the premiums for the permanent policies are higher than the premiums for the term policies. However, the later years, the term insurance becomes prohibitively super duper expensive. And that is very true. At the beginning of the term insurance will be very, very cheap. And then the permanent insurance will be expensive. However, towards the end, you can see that the permanent insurance become very, very cheaper than the temporary insurance. Now, there are different types of permanent insurance. There are three types actually of permanent life insurance. We've got whole life. Okay. Now, this whole life provides coverage for the entire life of the life insured. Premiums remain level and has a set death benefit, and it builds up cash surrender value over time. When applicable, the policyholder may be entitled to receive payment of the cash surrender value minus any surrender charges of the policyholder. Surrenders the policy prior to the death of the insured Now, another form of permanent insurance is term 100. So do we understand all these that we've just gone through are the features of whole life policies? Okay. Now the second, remember we said there are three types of permanent insurance: whole life, term to 100, and universal life. Those are the three types of permanent insurance. Now, term 100, also called T100, or 10 to 100, provides coverage for the entire life of the life insured. It has a set level premium that is lower than whole life. It has a set death benefit, normally no cash surrender value, and the policy matures at age 100. That is, premium payment stops at age 100, but life insurance coverage continues. Okay, do we see that? Now, with whole life, there's accumulation of cash surrender fund. All right, and you can set the payout period. You can set your whole life that you want it paid off in 20 years, in 30 years, and yet you have coverage for life. However, with 10 to 100, you're going to continue paying up until age 100. And if God blesses you, you live more than 100, you don't have to pay again after age 100. You will be covered until your final day on earth. And one important thing to note with 10 to 100 is that it does not accumulate cash back. Okay? Got it? Awesome. So we move on to the third types of permanent insurance, which is universal life. Okay. And this universal life is going to be discussed extensively in chapter 4. But in the meantime, I just want us to know that universal life provides coverage for the lifetime of the life insured, just like whole life has two parts to the policy: an insurance component and then also a savings component. It has a basic premium and an option to deposit more than the basic amount. That's right. This is called the excess premium, which goes into the savings component. Also, Universal Life has a minimum death benefit with an option to increase the death benefit. Very straightforward. Now, the savings account offers the policyholder a different investment options, and then it accumulates savings and investment. Investments are the accumulated savings and investments are tax sheltered and form part of the death benefit. Okay? Now, it's tax sheltered and it forms part of the death benefit. It means that it's tax deferred if funds are withdrawn prior to death benefit. All right? Okay, so now that we've gotten the brief definition of these three types of permanent insurance out of the way, and we have seen some of their attributes and components. Now we are diving deeper into each of them now. And in this chapter, we will be unpacking whole life and 10 to 100. But right now, it's 3.2. It's going to be whole life insurance. Now, whole life insurance is a form of permanent life insurance that typically guarantees the premium, the death benefits, and minimum cash surrender value for the policy. Your premium is guaranteed, the death benefit is guaranteed, and a minimum cash surrender value. It is sometimes referred to as a straight life or ordinary life insurance. Now, coverage term. Whole life is a form of permanent insurance in which the premiums, death benefits, and minimum cash surrender values are guaranteed. You see, that is the thing with whole life. It provides all these guarantees. And as long as premiums are paid, coverage is lifelong. The policies does not expire and cannot be cancelled by the life insurance company. Interesting. Policy reserve. Recall that the premiums collected by insurance companies are used to cover the risk of death. And when the policy is in its early years, the premium charged is higher than the amount needed to cover the risk of death. Now, what happened to those excess, right? Remember, it's because of the higher amount that makes this permanent insurance appears to be more expensive at the beginning compared to term insurance. All right. Now, the excess premium created a policy reserve, and the policy reserve is invested by the insurance company. You get it? That's right. And in later years, where the mortality cost or the risk of death is higher, and the premiums collected do not adequately cover the risk of death, the investment growth from the policy reserve is used to offset those shortfalls. You see, and that's why in the earlier when we're going through term insurance in comparison to whole life or to permanent insurance, that's what makes the permanent insurance to be cheaper in the later years compared to term insurance. Okay, how premiums are set. Okay, you can see now. The premiums for life insurance are calculated based on assumptions about mortality costs, expenses, and investment returns. These assumptions are projected over the life of the insurance contract, which could be as long as 50 or 60 years. Thus, insurance companies take a very conservative approach, excuse me, in their assumptions. That's very true. Okay. 3, 2, 3, 1. Okay, let me move my notes forward. Okay. Awesome. Now, how our premiums are set is number one, based on mortality cost. Mortality costs approximate the insurance company's cost of paying out policies death benefits. That is, annual estimated mortality cost is equal to policy's face amount times probability of death of life insured during the year. You get that? So now the estimated mortality cost is calculated by policy face amount. For example, if the policy face amount is 100,000, okay, multiply it by the probability of the death of the life insured during the year. So what is the probability of the life insured dying during the year? Remember at the beginning when we said the information, the data collected, it enables insurance company to put individual people into group by groups, and based on the characteristics of the groups, they are able to draw down on the statistics of the risk of death in those particular groups based on age, based on gender, based on lifestyle, based on family health history. Remember that, right? We treated that in chapter 1. Yes. So is those statistics, for example, we're going to see an example later on, but let's continue. Okay. With the term insurance, the policy could expire before the death of the life insured. There is a chance that the insurance company will not pay, will not have to pay the death benefit. However, with a whole life policy, the insurance company will eventually have to pay the death benefit. And that's where the calculation comes in. That is the face amount multiplied by the risk of one dying in a particular year. Okay. Now, in calculating premium for a whole life policy, the insurance company spreads the calculative annual mortality cost over the anticipated life of the insurance contract. Okay. Now, expenses. These are expenses that the insurance company um, 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 kind of have to incur in the course of disbursing or in the course of doing this business. Now, the premiums of a whole life policy covers the insurance company's administrative expenses, which includes marketing expenses, salaries and commissions to agents, like to us. Now, processing the applications, paying for medical exams, paying income taxes, investigating claims, paying death benefits. See, these are associated expenses that life insurance companies have to undergo. Okay, because some people they'll have to do their health, they have to call a nurse to go draw the blood and all those kind of things. Also pay all the advisors and stuff like that. With whole life policy, the insurance company must estimate the future cost of these expenses. Now, investment returns. We've talked about the costs or the rather the expenses. Now let's take a look at the investment returns. Recall that mortality costs are lower at the beginning of life insurance. Well, yeah, that's typical because when people are younger, the mortality rate is lower. But as they get older, the mortality rate increases, and then that increase the mortality cost. Okay. Now, and higher at the end. Insurance companies invest the policy reserves to achieve positive investment returns, which can then be used to offset the higher, excuse me, mortality costs later in life of the life insurance contract. The life insurance company must make assumptions about the returns it will make on those investments over the duration of the life insurance contract. When calculating the premium for the whole life insurance contract, stock market history has shown time and time again that investment returns in reality can differ greatly from projections. Very true. Now, impact of model factors. What are the impacts of model factor on all these scenarios? Life insurance premiums are normally quoted on an annual basis. Oh, by the way, when we say model factors, we are talking about the model of payment. Okay. Now, life insurance premium can be paid annually, can be paid biannually, and it can be paid monthly. Now, the annual premium paid at the beginning of the year gives the insurance company the funds to invest for the year. However, policyholder, is given the options of paying the premium monthly, quarterly, or semi-annually. When a policyholder chooses one of these payment schedules, the insurance companies compensate for not having access to the full sum for the year by charging a model factor to the policyholder. Now, the model factor means the policyholder pays more for the premium. Okay? The model factor reflects the lost investment income that the insurance company could have earned on an annual premium. When an individual opts out for a monthly, quarterly, or semi-annual payment schedule, the premium paid will always be higher than the annual premium due to the modal factor being applied. So what this is telling us in essence is, you see, when you're paying your premium annually, that is giving the insurance company money ahead of time, which will enable them invest the money and get more returns, right? And that is why when people paid for their premium annually, their premium is cheaper than those that are paying monthly. All right? Those that are paying monthly premium are calculated as annual premium multiplied by modal factor. Okay? So that is how much they will have to pay more. Now, sample modal factor for term and whole life policies are shown in this table. All right? So this is modal factor and this is the payment frequency. Now, if somebody is paying semi-annually, they take the annual premium multiplied by this. If they're paying quarterly, is the annual premium multiplied by this. And if they are paying monthly, then it will be the annual premium multiplied by this. For example, Victor bought a whole life policy with an annual premium of $956, but he wants to pay premium on a monthly basis. If the model factor is 0.08, his monthly premium will now be 84.13, calculated as 956 multiplied by 0.08. Now, over the course of 1 year, he will pay a total of 1009.56 in premium, calculated as this times 12. Okay, this is a very straightforward calculations. So just know that if you are asked to calculate the model premium, is typically straightforward. It is the annual premium multiplied by the model factor. Okay. Um, let's see, the model factor, yeah. Awesome. Now, the premium options. Premium never increases regardless of the way they are paid. Okay. Depending on the whole life insurance contract, the policyholder will have several options for paying premiums, such as the following options as discussed below. 1 second, let me drink water. Okay. So that helps me from yawning and yawning. All right. Ongoing premiums. This traditional premium is paid at fixed price on an ongoing basis for the life until the policyholder surrenders the policy. And this form of premium can be called a lifetime pay policy. For example, Helena is 40 years old, a non-smoker, and in excellent health condition. She just obtained 500,000 whole life policy on her own life. Her premium will be 11,065 annually, and they are guaranteed to never increase. Okay. Now, this is ongoing premium. Now we move on to single premium. The premium can be paid once in a lump sum. Now the policy is then paid up and no other premiums are required to keep the policy in force for the life of the insured. Wow. A single premium policy is a paid up policy. Now, limited payment. Do we understand that? Ongoing premium is that the premium you keep paying every year or depends on the model of payment, okay? If it's annually, you continue to pay annually. If it's monthly, you continue to pay monthly. That is ongoing premium. Now, if it's a single premium, it's a one-time boom. You drop the money, the policy is fully paid up, and you don't need to pay again, and yet the person is covered for life. All right. Now we move on to limited payment. Premium payments may be limited to a set number of years, to a set or to a set number of age. At the end of the period, the policy is then paid up. This form of whole life is detailed in section 3.6. Yes. So this is a limited payment. You can choose to like, okay, I want this policy paid up in 5 years, paid up in 10 years, paid up in 20 years. We say that all the time. For some of you that have gone on field training with your trainer or with myself, you would have had the opportunity to see that we can actually choose to pay up a permanent policy within a specified period of time. All right? Death benefit options. So we'll talk about those premiums. We talked about single premium, ongoing premium, and limited payment. Now let's move on to death benefit options. Now, depending on the insurance company, the policyholder may also have some choices as to how the death benefit is determined. The policyholder may the policyholder has a choice between guaranteed whole life and adjustable whole life. Oh, interesting. So, what is guaranteed whole life, you may ask? As its name indicates, this form of policy guarantees the death benefit and sets a premium The insurance company takes on all the risk with the guaranteed whole life insurance policy due to its assumptions about pricing factors. All right, adjustable whole life. So this guaranteed whole life, like everything is cast on stone. Like the death benefit is locked in, right? The premium that will be paid is locked in. Nothing is moving, nothing is shaking, nothing is shifting, right? Ah, kid, okay. Now you got it. Now let's move on to adjustable whole life. This, remember, this is as it relates to death benefits. Okay, got it? If you didn't get it, don't forget about it. Make sure you get it. Rewind, replay, relearn. Okay? Now, moving on. Adjustable whole life. With this form of whole life insurance, the death benefit and premiums are guaranteed for a certain period of time. Like for example, 5 years. At the end of the guaranteed period, the insurance company will compare its mortality cost projections to its actual experience. The experience is the reality, like how many people dies. That is the experience. You see, in this course, right, you're going to be hearing the word experience, right? So when you hear that word experience, is their actual reality. Okay, so when they compare with their experience with the actual because it maybe they make projections that 10 people will die. Maybe their real experience is that 20 people died, or like COVID happened and you understand. So now they'll go back to drawing board, reevaluate, and update its assumptions again about mortality costs, expenses, and investment returns. And based on its review, the insurance may adjust the policy by increasing or decreasing either the premium or the death benefit or both. Wow, this is interesting. This adjustable whole life, nothing is cast on stone. Tell me in the comment section, would you like to have a policy that have this kind of uncertainty attached to it? I wouldn't, right? Premiums are typically lower in adjustable whole life policy because the policy holder is exposed to more risk than with a comparable guaranteed whole life policy. Yeah, yeah. Okay, so that could be it, right? Because the premiums are usually lower based on their current experiences and assumptions and projections. And then as they move further, maybe by the 50th or 10th year, depending on the contract, so they reevaluate their experiences and then reproject. And then at that point, they could reduce the death benefit or increase the premium or both. Okay, awesome. Moving on, as such, if the insurance companies, you see, this as such is coming from the last statement where we learned that policyholder is exposed to the risk with comparable guarantees. Yes. So in adjustable, you as a policyholder, you are the one exposed to the risk. So as such, if insurance companies' actual expenses slash costs are higher or investment returns are lower than it has forecasted, premiums may increase or the death benefit may increase. Yeah. And if the insurance company's actual expenses and costs are lower, and does anything get lower? Anyways, or investment returns are higher than it has forecasted, the premiums may decrease or the death benefits may increase. Okay, if the insurance company's actual expenses slash costs are in line with the forecast, premiums or death benefit may remain unchanged. Interesting. So while available, adjustable policies are no longer in common use in Canada. Yes. And look, I haven't even seen, I haven't sold one myself. You see, this is an example. Randy purchased an adjustable whole life policy 10 years ago with an annual premium of 6,500, guaranteed for 10 years. As a result of its 10-year review, the insurance company determined that men who had purchased the same policy as Randy's are actually living longer than expected. So the company has had to pay out less death benefit than expected, and the insurance company reduced Randy's premium to 6,415 annually, guaranteed for the next 10 years. Ooh, and that's a very good one. Well, let's look at the second one. Helmut purchased an adjustable whole life policy 5 years ago with an annual premium of 11,600, guaranteed for 5 years. As a result of his 5 years review, his insurance company noted that market interest rate has dropped and that as a result, they have earned less income on their policy reserves than expected. The insurance company increased Helmut's premium to 12,100. Imagine, from 11,600. Wow, that's additional 500 guaranteed for the next 5 years. So we've seen the two scenarios that play here. You see, one is where they did better than expected, so they compensated the policyholder by reducing the premium. But the other one, things didn't work as planned, so the policyholder get to pay more. All right? Okay. So we've taken, you see, now we've unpacked our whole life. We've seen, the whole life, the model of premium, model factor. That is, the model factor is how you pay, right? And if you pay annually, your premium is no, is discounted. Or if you're going to be paying monthly or quarterly, now there's a modal factor that comes into play, right? Because the insurance company is not getting access to that money right off the bat, right? Because you're paying monthly. So, and the calculation for that is your face amount multiplied by the modal factor. Okay, that is a very straightforward thing. And we also talked about the different types of premium payment, ongoing premium, a one-time premium, and a limited premium payment options. Okay, so I hope you're getting value, because that's my goal here. I want to bring this thing down. This thing that you are looking at it and saying is such a big deal. I want to demystify for you that, hey, guy, hey, girl, you got this, okay? And we got you too, right? And right about now, if you have not left any comment, leave a comment. Do you like the class so far? Is it helping you so far? Leave it in the comment section. And if you're yet to subscribe, what else are you waiting for? This is your way of saying, hey, thank you. So click on that subscribe button. Thank you very much for that. With that being said, we move to non-participating versus participating whole life. Okay, let's talk about participating and non-participating. I'm just trying to make this interesting for you guys, okay? And we can call it par and non-par. Whole life policies can be either participating or non-participating, depending on how the insurance company handles any surplus that results from the policies. Okay? Participating policies offers the policyholder the option of receiving a shares of the insurance company's surplus revenue in the form of dividend. That is participating. You see, when you say participating, you're participating in the goodies. You're taking part in the goodies, okay? So when you're, okay, participating, you're getting dividend, taking part in the dividend, you're eating the benefits of the goodies when it happens. Non-participating policy keeps surplus revenue as retained earning, which increases the company's shareholding equity. Okay, so the not participating is that they don't participate in. Oh my God. What am I saying? They don't take part in the goodies. Okay, now how shortfall or surplus occurs. This shortfall or surplus that occurs that results in this dividend, how do they occur? Recall that insurance company forecast mortality costs, administrative expenses, and investment returns based on assumptions made about life expectancy, probability, and death and economic market conditions. So these forecasts can be wrong, right? Mortality costs can be lower or higher than expected. Fewer or more people may die, right? For example, all the mortality cost forecast for 2020 to 2021, I'm 100% sure will go out the window. Why? Because of COVID-19, right? Good. Now, investment returns can be higher or lower than predicted, and administrative expenses can be higher or lower than estimated. So, to the extent that actual mortality costs and expenses are lower than the expected and investment returns are higher, then the insurance companies will have surplus revenue. This kind of makes sense, right? I think this is very straightforward, so I don't need to overflog it. Now, surplus revenue, that is when revenues are more than the company's needs for its administrative expenses. They will first be used to top up companies' policies reserve. Now, insurance regulators specify a minimum level of reserves that must be maintained to meet future liabilities or pay out debt benefits. Now, after the reserve levels are met, the surplus becomes company's profit. And if there is a shortfall, that is, the revenues are less than the company's needs for its administrative expenses, then the company must call upon its financial resources. It cannot seek more premium or reduce debt benefits. Yeah. Okay. So that is that on participating policies. Okay. Now let's take a look at non-participating. For the participating policies, we see that okay, it's a goodies that everybody participates in, right, in form of dividend. And how does the insurance company arrives at this surplus that they can share in form of dividend? And that has just been explained to us in a plain term and simple. Okay. Now moving on to non-participating policy. A non-participating policy, or rather a non-par policy, does not share any company surplus to its policyholder. No goodies will be distributed. Okay. Okay. Surplus revenues are first used to maintain policies reserves level as required by provincial regulators. And after the policy reserves are met, the excess revenues are kept as profits. Now, profits are added to the insurance company's retained earnings, which increases the company's shareholders' equity. Alternatively, some or all of the profits can be paid out to the shareholders as taxable corporate dividend. Ooh, I would love to be a shareholder here. Inaccurate assumptions regarding non-participating policies can result in revenue shortfall for the insurance company, and the insurance company and not the policy or the policyholder bears the burden of this loss. Because when you were enjoying, you eat alone, so you bear it. Okay? Yeah. Even the participating whole life company with their shortfall doesn't come back to policy owners. So we've said that before in the previous point. All right, participating policies. I think they are going to give us more detailed content for participating policies. Participating policy is a policy that is structured to pay the dividend, okay? And is also called a PAR policy, a policy that pay good, pay dividend. See, painting, okay? Now, with the participating policy, the insurance company will first use the excess revenue to meet their regulatory requirements of maintaining the specific level of reserves. Once the specific level of reserves is reached and maintained, then to the extent that the excess returns are not needed to maintain the policy reserves, then the insurance company may return some or all of those revenue surplus to its policy holders in the form of dividend. Okay. Now, these dividends are not to be confused with corporate dividends. The dividends paid to PAR policy owner is not the same as the dividend paid to an investor who owns shares of the company. Okay, dividends are not guaranteed. And the agent must disclose to a prospect that there is no guarantee that a dividend will be paid. The insurance company bears the responsibility alone for revenue losses resulting from inaccurate assumptions regarding participating policies. So participating policyholders have the potential to share in revenue surpluses. Therefore, the premiums are higher than non-participating policies. Okay, now. You see now, you see the catch. So because participating policies take part in sharing the dividends, so their own premiums are typically higher than non-participating whole life policies. All right. So what are the differences? Identifying the difference. Now, most participating whole life insurance products includes the word participating in the product name. Also, participating policy contract will clearly specify how and when policy dividends will be paid and will include a caveat that policy dividends are not guaranteed and are only paid at the discretion of the insurance company's board of directors. Okay, now. All right. Dividend payment options for participating policies. Mark this one. You're going to see it in the exam. Dividend paying options for participating policies. In other words, the dividends that you're going to get, you have options to it. Okay. When he applies for a policy, the policy owner may choose from a variety of options with regards to how he wishes to receive the dividends. He can switch to another option at later date. So at the point of application, you can choose how you wishes to receive your dividend. Okay. However, you can switch at a later date. Okay. You can choose to receive your dividend in cash. You can choose to receive your dividend in form of premium reductions. For example, if your premium is 1,000 per annum and your dividend is 500, you can decide to use your dividend to reduce your annual premium. Or you can accumulate your dividend. You can say, okay, keeping it for me, when I need it or when I need something, when it becomes tangible, then I take it in bulk. Or you can use your dividend to pay up additions. That is, use it to buy additional stuff. All right. You can also use your dividend to take on a temporary insurance. Also, you can use your dividends to use towards the impact on debt benefits and cash value. All right, we're going to be looking at each of these one by one. It's going to be fun. It is going to be fun. So let's look at cash options. You see, when you choose to receive your dividend in cash. So the policy owner can choose to receive the dividend in cash. It is issued by check to the policyholder or by direct deposit to the policyholder's account at their financial institution. Now, who benefits? This form of dividend use is best for the policyholder because he receives hand, cash in hand to use as he wishes. If he chooses, he can use the money to pay premium or to repay policy loan or whatever he or she chooses to do with the money. It's up to the policyholder. Okay, we move on to the next one, which is premium reduction. Like I briefly said before, the policyholder can choose to apply the dividend directly against the premium for the following year. It will reduce the amount of premium to be paid by the policyholder. This is also called premium offset. Now, in early years, the policy dividend is usually less than the premium. However, in later years, the policy dividend may be more than the premium, completely offsetting the annual premium. If the policy dividend exceeds the premium, then the policyholder can choose to have the excess paid out or allocate to one or other dividend options available. Okay? So if this option is exercised, who benefits? This form of dividend benefits the policyholder because its premium cost is reduced. Okay? The third option is accumulation of dividend. Quick 1 second for a water drink. Awesome. Accumulation of your dividend. Now, if the policyholder choose the accumulation options, the policy dividend will be deposited into a separate accumulation account called a side account. All right. Now, the accumulated dividend in the side account is invested to provide additional growth. Now, the value of the account can be withdrawn by the policy holder whenever he or she chooses. Account growth in the side account is taxable to the policyholder. Now, the value that accumulates in the side account can increase the death benefit as long as it is not withdrawn first. In this choice of dividend payout, who benefits? Well, this form of dividend payout benefits the policyholder who can access the cash via withdrawal as well as the beneficiary because the death benefit is increased by the accumulated fund value. So true. All right, let's move on to investment options. Investment options. Now, dividend deposited to the side account and interest, right? Now, the policyholder may choose to invest in segregated funds instead of earning interest, okay? Now, these segregated funds are an insurance industry investment with some similarities to mutual funds. And upon death, the value of the side account is paid to the beneficiary along with the death benefit when the policyholder dies. That's a good one, right? It's like having another investment in your whole life policy. Interesting. That's a good one. Now we move on to another ways in which we can receive dividend. That is by through pay up addition. Okay. Now the policyholder can choose to use the dividend as a single premium to buy more whole life insurance. And these are known as paid up addition. That is, you're paying up an additional coverage. Okay. For example, if your dividend is $1,000, okay, and right now you have 500,000 whole life, and then maybe this your 1,000 can buy you additional 5,000 universal life paid up one time. So it means that will increase your death benefit from 500,000 to 505,000. Isn't that so cool? You use it to pay them. Remember, this additional policy is paid up by your dividend. So there's not going to be, nothing is going to impact your existing premium because this additional coverage is fully paid up using your dividend. Okay. Each addition to the base policy is paid up, hence the name paid up addition. Okay. Each paid up addition is its own policy with its own death benefit and cash surrender value. Exactly. And its coverage is a result of the amount of dividends at the attained age of the life insured. Now, a paid up addition can be surrendered without affecting the base policy or other additions. All right? Additions can be cashed in and used to pay premiums and therefore also achieve premium offset, the same as a premium reduction method that appears in chapter 3.4. Okay? Uh-huh. Are you thinking, do you want me to explain this? I think this is pretty much straightforward. This is telling us that this addition can be cashed in or are used to pay premiums and therefore also achieve premium offset. Okay? Now, paid up addition increases the death benefit without the need to provide evidence of insurability, and thus paid up additions can be used to increase the amount of insurance coverage when, even if the life insured's life has deteriorated to the point where he or she will no longer qualify for a new insurance coverage. Therefore, paid up addition are the most popular dividend payment options. Over 90% of whole life policies sold use these options. And talking about winning, who is the winner here? Well, this form of dividend uses benefit both the policyholder who can use paid up addition to reduce their premium expenses and the beneficiary by increasing their all right, that is amazing, isn't it? Remember, paid up addition, okay, is everything that we have explained so far. So we are moving on to term insurance. Okay. Now we can use our dividend to take on a temporary insurance. Okay. Now the policyholder can choose to use the dividend as a single premium to pay for a 1-year term insurance policy, depending. For example, if you need a 1-year temporary insurance and they maybe 1-year temporary insurance of 100,000 and the premium is 1,000. Now you can use your dividend of 1,000 to pay off that term insurance of 1 year. Okay? That is simple. Now, the term policy has its own death benefit, which is paid if death occurs during the year. Like the paid up addition, the term insurance coverage is a result of the amount of dividend and the attained age of the life insured. So medical evidence of insurability for the additional term insurance is not required. Okay? And in this instance, who is the winner? Who is benefiting? Who is gaining? Well, this form of dividend uses is best for the beneficiary if death occurs during the year. because the death benefit will increase. Exactly. For example, if this person have 100,000 of whole life, sorry, 500,000 of whole life, and it takes on this 100,000 term for 1 year. Well, if the person passes away in the course of the year, the beneficiary will receive 600,000. Okay. All right. The impact on death benefits and cash value. So, what is the impact of um, all these different ways that we receive dividends? Okay, on death benefits and cash value. Well, participating policies, dividend payment options have different effects on the death benefit and cash surrender value of the policy. Now, let's take a quick look at that. Uh, two, two, three, two. All right. So, paid up addition may increase both the cash surrender value and the death benefit. The accumulated options may increase the death benefit if the accumulated dividends have not been withdrawn by the policyholder. Now, the term insurance option may increase the death benefit temporarily if the length of 1 year term only. Okay, dividend illustrations. All right, so I love seeing their examples. Why? Because it kind of makes the it creates a picture of everything we've been talking about for a little while now. All right, dividend illustration. A dividend illustration is a chart or a graph that an agent uses to help policyholder understand how participating policy works and to visualize the dividend and their effect on death benefit and cash value. Now, dividends are based on dividend scale constructed by the insurance company. Now, the scale groups policies into blocks, and each block has its own expenses and investment returns, which are based on assumptions, that is, investment returns assumptions. Now, the dividend illustration is based on the dividend scale. The illustration is a projection of what might happen in the future. It is not guaranteed because no one can predict what the future holds. Now, if only one projection is presented to a potential policyholder, an impression can be created that the returns in the illustrations are a sure thing to overcome these expectations. Dividend illustrations are usually based on at least two dividend scales, and one is less optimistic than the other. Okay. Whew. Now, non-forfeiture benefits. Non-forfeiture benefits are advantages received by the policyholder that result from paying premiums and building a cash value. Now, these benefits are not forfeited when the policy is cancelled, even if the cancellation is due to non-payment of premium. Okay, the longer the cash reserve builds, the greater the value available for the non-forfeiture benefit. Therefore, a policy that has been in force for 25 years will have a large sum available in non-forfeiture benefits than a policy that has been in force for 5 years. Now, depending on the insurance company and the policy holder may be able to take advantage of one or more of the following non-forfeiture benefits. Okay, let me explain. when we talk about non-forfeiture benefits, this is looking at the benefits you have that keeps your policy in force without it being lapsed. No, that's not the correct English. But in other words, the benefit you have as a result of having built a cash value over time that is able to keep this way the engine of your policy spinning even when you are not paying policy and bring your premium. Okay. And your premium will still be active. It won't go into um in other words, you won't lose your distance anyways. So let's move on. Now, the following are non-forfeiture benefits: cash surrender value, automatic premium loan, reduced paid up insurance, and extended term insurance. Now, cash surrender value. Okay. A whole life policy can be surrendered or cancelled, that is cancelled. A whole life policy holder can cancel or surrender his policy at any time. He will receive the cash surrender value or the policy from the policy from the insurance company. The cash surrender value is the accumulated fund in the policy. Okay. So now when this policy holder chooses to cancel or surrender his policy, all the cash value that have been accumulated in that plan will be sent to the policy holder. In comparing the cancellation of a whole life policy to a term policy, the term policy holder receives nothing. A portion of the cash surrender value that the policy holder receives will be taxable. Okay? Now, typically, a whole life insurance policy will indicate what the guaranteed cash surrender value will be at the end of each policy year. And the illustration may also show a non-cash surrender value, a non-guaranteed cash surrender value, amount that may result from policy dividend if it is participating policy with a paid up addition option. Okay. All right. Why take on why take the cash surrender value? Number one, why do we assess our cash surrender value? Why do we draw on our cash surrender value? Number one, the need for insurance coverage has changed. Number two, ability to pay for the insurance have changed. Okay? Now, surrender charges. Surrender charges are usually levied against a policy's cash value to discourage the policyholder from cashing in the cash policy before the insurance company can recover the expenses. That is from the underwriting, administrative costs, agent commission, and incurred for issuing the policy. Okay? Now, a fee is charged. Now, do we understand the cash surrender value, right? That is the money they levy, the insurance company put on the policies to enable the policy grow enough cash value for the insurance company to take out all their expenses incurred in the cost of setting up the policy. Okay? Awesome, awesome, awesome. So moving on, surrender charges decreases over time and are eventually eliminated. Now, for whole life insurance policies, the surrender charges are not typically specified in the insurance contract. Rather, the illustration of the policy's guaranteed cash surrender value will show zero for the first 3 or 10 years before beginning to increase gradually. Policy loan. Now, Up to 90% of the cash surrender value is available to the policyholder as a policy loan. The policy loan does not have a specified repayment schedule. Interest is charged on the loan and they accumulate if the loans and interest are not repaid. Okay? Now, the amount of the loan and its unpaid interest are deducted when the policy is surrendered, and the deduction is made from the cash surrender value. And when the life insured dies, the deduction is made from the death benefit. Okay? Now, why take a policy loan? Other sources of borrowing are unavailable. Number two, a large cash surrender value exists in your plan. Okay, so why keeping the money there? The loan does not appear in credit reports. For example, Yolanda owns 500,000 whole life policy on her own life with a cash surrender value of 120,000. She took 80,000 policy loan to use as a down payment for a cottage, and the loan interest is 5% compound annually. 2 years later, she decided to surrender the policy. At that time, the cash surrender value had increased to 136,000, and she still has not made any payment of the loan. Yolanda will receive 47,800 upon surrendering the policy, which is calculated as the cash surrender value of 136,000 minus the 80,000 she borrows as standing loan, and also the accrued interest of 8,200. If she has died instead of surrendering the policy, her beneficiary will have received 411,800, which is calculated as the death benefit of 500,000 minus 80,000 loan and then 8,200 of interest. Good. Okay, that's exciting. Anyways, and pretty much straightforward, right? Okay, let's move on to automatic premium loan 352. Automatic premium loan. Are you learning something? You're learning. Yeah, with the way it's going, this chapter 3 is loaded, with a lot of information. So don't worry, we'll soon be done with chapter 3 and we will stop at chapter 3. I think it's best we break this so that you guys can eat it. So when chapter 3 is done, I will break it there and then do chapter 4 in a different class. Okay? All right, let's move on to automatic premium loan. Now, it is essential for premiums to be paid to keep a policy in force unless the policy is paid up. Okay? Now, the automatic premium loan is a loan that uses the cash surrender value of the policy to make individual premium payment. If the policyholder fails to make scheduled premium payment, interest is charged against each loan. Now, the automatic premium loan occurs automatically when the premium goes unpaid or if the policyholder gives permission for the loan or loans. Okay? A premium loan can be taken from the cash surrender value once or many times. The policy will state a limit on what makes it to be a loan. Okay? Now, when the policy loan limit is reached, usually between 90% and 100% of the cash surrender value, plus a 30-day grace period, the policy terminates and the residual cash surrender value, if any, will be paid to the policyholder. Like usual policy loan, the outstanding balance and interest of any automatic policy loans will be deducted from the death benefit. What is the benefit of automatic policy loan? Well, here are the benefits. Number one, it prevents policies from lapsing due to forgetfulness. Okay? Now, number 2, it eases financial pressure on the policyholder whose financial situation prevents usual premium payments. For example, Ella owned 500,000 whole life insurance policy with cash surrender value of 226,000 and annual premium of 11,500. She has been forced into early retirement, resulting in substantial drop in income, and she would like to keep the policy in force to meet her estate planning needs. But she cannot afford the premium until her Canada Pension Plan CPP and old age security benefits. Ella can keep premium for the next 5 years by issuing the automatic premium loan provision because she has enough cash surrender value to support this option. While this will reduce the death benefit by the amount of the unpaid premium plus interest, it will allow her to keep the policy. She will also always have the option to repay the loan and interest if and when she can afford it, which will restore the death benefit back to the original amount. Okay, reduce paid up insurance. Now, this is an option for a policyholder who wants insurance coverage without continuing to pay premium. Yes. Now, it provides the policyholder with a paid up insurance that is fully paid up. Like I said before, it could be 5,000 insurance that the fully paid up premium is 1,000. And then this policyholder can use the dividend of 1,000 to pay up. All right. Now, the reduced paid up insurance is acquired when the cash surrender value of a policy is converted into a single premium. Now, if you convert your cash surrender value into a single premium, let's say you have 100,000 into your cash surrender value, right? And this is 100,000 is a one-time paid up coverage for 500,000. So you can use that 100,000 to pay up for additional 500,000 coverage, bringing your coverage to 1,000,000 if you have 500 before, right? Now, let's see. The reduced paid up insurance is acquired when the cash surrender value of the policy is converted into a single premium. That premium pays for a new whole life policy with a smaller face amount than the original one. And then the amount coverage is determined by the amount of cash surrender value available, of course, and the attained age of the life insured. There is no need for any medical or insurability. This card policy holder doesn't need to provide any insurability or this thing. No, that's a good one. Now, the reduced paid up insurance result in a smaller death benefit as well as permanent coverage. For example, if Ella feels that she will never again be able to afford the 11,500 in annual premium on her 500,000 whole life policy. She may also opt out to use the cash surrender value of 226, assuming she never exercised the automatic premium loan option. As a single premium to purchase a paid up permanent insurance policy, and the exact amount of death benefit will be depend on her age, but it will be less than the 500,000 provided by the original policy. Yeah, that's true. Extended term insurance, extended temporary insurance. Okay, so these are, remember, we're talking about what we can do with our cash surrender value, right? This another option for a policyholder who wants insurance coverage without continuing to pay premium. If it also provides paid up insurance, but converts the whole life policy into a term insurance. Okay? Now, the extended term insurance is acquired in the same way as reduced paid up insurance. Now, the cash surrender value of a policy forms a single premium. However, with this option, the premium pays for the new term policy with the same face amount as the original whole life. Wow. The duration of the new policy's term is determined by the amount of cash surrender value available and the attained age of the life insured. A large cash surrender value and a young attained age might pay for a term policy that expires in many, many, many years. A large cash surrender value and an older attained age might pay for a term policy that expires in years, but fewer years than when the policyholder is younger. There is no need for medical evidence of insurability. In some, extended insurance result in the same death benefit as well as the temporary insurance coverage. For example, that is like we're still looking at our Ella example. Okay, Ella feels that she will never again be able to afford 11,500 in annual premium on her 500,000 whole life policy, but she wants to keep coverage for 500,000 in place as long as possible. So she may be able to use the cash surrender value of 226,000, assuming she never exercised the automatic premium loan option, as a single premium to buy 500,000 in term insurance, and the exact term of the policy will depend on her age. Wow, interesting. That's a straightforward one, isn't it? Now, limited payment of whole life. Limited payment for whole life. Limited payment life is a whole life insurance policy that provides lifelong insurance coverage while limiting the premium payment period to a set number of years or to a specific age. Once premiums are no longer required, the policy is said to endow. Now, the premium for a limited pay policy will be higher than the whole life policy where premiums are payable for life. This is because the life insurance coverage continues after the premium payment stops. The insurance company determines the limited payment premium based on the sum of premiums the policyholder will pay for his entire life based on his assumed life expectancy. The company uses this sum to determine the premium it will have to collect over the limited payment period to obtain the same financial result. Why choose limited payment over a lifetime pay? Okay, so the limited pay is, for example, someone is 35 years old now, right? And retirement age in Canada is 65. So this person can choose to pay up the life insurance in 30 years so that by the time the person is out of active workforce, they don't have to keep paying life insurance premium again, but they will have coverage for life. Okay, so this is what this is all about. And because they are compressing the payment of their policy to 30 years, the premium tends to be higher. If they're going to be paying for 40 years or 50 years, the premium will be lower. Okay? All right, moving on. Why choose limited payment over lifetime pay? Well, the policyholder knows when his premium commitment ends. Yeah, And the policyholder can coordinate premium payment with income. Premiums can be time to earn at retirement, just what I just mentioned, right? Now, the policyholder also avoids longevity risk in which he could be paying premium for a life insured who lives longer than anticipated. That's very true. Okay. Premium offset policies. Now, um, for premium offset policies, this refers to the use of policy dividends to reduce the amount of premium paid by the policyholder. It is not a type of policy, but rather an option. Okay? Mhm. It is an option. Premium offset can be achieved by premium reductions that uses policy dividends to pay premiums directly. All right, paid up addition in which annual dividends are used as a single premium to purchase. Now, these paid up additions have their own cash surrender value, which grows over time as well. And these paid up additions are then cashed in, and the cash surrender value is used along with annual dividend to cover the required premium. What is the benefits of premium offset? Well, the policyholder pays less, therefore they may be more easily persuaded to buy a PAR policy. Illustrations in this code. Agents need to exercise caution when marketing policies with these provisions to prospect clients, because policy dividends are not guaranteed. Agents must clearly relate to the policyholder that the illustrations are based on the present dividend scale, and the dividend scale could fluctuate. Policyholder must understand that small changes in the dividend scale could produce drastically different results. Therefore, the benefits associated with dividend may not materialize if the dividends are not paid or deviated from the dividend. Oh boy, deviated from the dividend scale. Advantages, and disadvantages of whole life insurance. The advantage and disadvantages of whole life insurance policies are premiums are guaranteed. Yes. How about disadvantage? High initial cost in the early years of the policy, and the premiums for the whole life insurance will be higher than that for the same amount of term insurance, which may make it cost prohibitive for people with limited cash flow. Yeah. Okay. Coverage continues for life. Regardless, the advantage of whole life is that coverage continues for life, regardless of the health of the life insurance. Yeah. Participating whole life policies may result in policy dividends, which the policyholder can receive in cash or choose to accumulate in an investment that inside account or used to buy paid up additions. Okay. On the disadvantage side, policyholder has little or no choice over the policy reserves. Yeah. And for participating whole life, policy dividends are not guaranteed. Even a small change in the dividend scale. Therefore, it's a theory that suggests buying term insurance and investing the difference may result in better financial outcome, provided the policyholder is disciplined to invest the difference. That is on the negative side. Then on the positive side, in the later years, whole life policy premium will likely be less than the premium for the same amount of temporary insurance on a person of the same age. A whole life policy may offer a non-forfeiture benefits in addition to the cash surrender value, including automatic premium loan or reduced payoff additions and extended term insurance. All right. Policyholders may be able to obtain a policy loan against the cash surrender value. Now let's move on to this side. The way the policy reserve is invested or managed is not entirely transparent to the public. Yeah. Now, compared to more additional guaranteed investment, the dividend payment rates on participating policy has historically had lower standard deviation, lower volatility in returns. Now, wow. Comparing term and whole life. So we just finished looking at advantages and disadvantages of whole life. Now, what is the comparison? Summarize the difference between term insurance and whole life. Okay. Term insurance provides okay. Yeah, term insurance provides insurance coverage for a specified period of time. However, whole life insurance provides for a lifetime. Coverage for term insurance is usually not available past certain age, such as 75 or 80, and coverage is available for life regardless of age with whole life. Now, the term insurance can be selected to meet the needs, specific needs for a specific duration. Well, term cannot be customized to a specific duration, but whole life can be. At any time. So now, term insurance premium generally increases with the age of the life insured, and the premium generally remains constant regardless of the age of the life insured. Now, for term insurance, when the life insured is relatively young, the premiums are generally lower than the premiums of the same amount of the whole life coverage. Now, for whole life, while the life insurance is relatively young, premiums are generally higher than the premium of the same amount of term coverage. For term insurance, as the life insured ages, the premiums eventually become higher than the premium of the same amount of the whole life coverage and may eventually become very, very expensive and prohibitive. All right. Now, for the whole life, as the life insured ages, the premiums remains level eventually, and there will be lower than the premiums will be lower than the premium for the same amount of the term. Okay. Renewability. Now, depending on the contract, the policy may be non-renewable or the life insured may have to provide a medical evidence of insurability for renewal. However, some term policies are convertible, which allows the policies to be converted to a permanent one, such as whole life, without providing any new medical evidence of insurability. And then we'll come back here. We can see that policy never required renewal, while requires renewal. Yes, the whole life policy never requires renewal and will remain in force even if the health of the life insured declines. Okay? Awesome. All right, so let's talk about cash surrender value as it applies to term insurance and whole life. Well, as we all know, term insurance doesn't build any cash surrender value. It doesn't build up cash surrender value. So policy has no cash value, okay, upon expiry or termination. Well, however, with whole life, policy never expires and it builds up cash surrender value over time. Policyholders can receive cash surrender value if they terminate or surrender their policy. Now, how about investment? All right, how about investment? Well, policy will not provide any dividend now. Well, with whole life, a participating whole life policy may provide policy dividends, although they aren't guaranteed. Okay? In temporary insurance policy, you cannot borrow from the policy. There's nothing there for you to borrow from, right? However, for whole life policy, policyholders may be able to take out some policy loans against their cash surrender value. Now, benefits. Okay, policy does not provide non-forfeiture benefits, but with whole life, the policy may provide non-forfeiture benefits, which generally increases the cash, which generally increase in value the longer the policy is in force. Okay. When did I say cash before? Oh boy. All right. Now, death benefit cannot be increased without providing medical proof of insurability without payment of additional premium. Well, for whole life, death benefit can be increased without providing proof of insurability and without paying additional premium by using a paid up addition option or by leaving policy dividend in the accumulated form. All right. So that is all the gains and advantages and disadvantages or the differences of whole life and temporary insurance. Okay. Using whole life insurance. A whole life policy is an appropriate choice when the need for insurance is permanent. That is, the policyholder enters the policy for the purposes that arises at the end of life. For the life insured, okay, the policyholder will be able to afford the premium for the selected premium payment schedule, that is once or limited or lifetime, depending on the payment option that was selected by the policyholder. And the policyholder wants this insurance coverage to increase, for instance, to keep pace with inflation and is prepared to select a par policy that will accomplish that objective. And also, the policyholder does not want an investment aspect of his policy. Okay? All right. So we move on to taxes upon death. Hmm. You see, sometimes I tell people that in Canada, and that holds true in US too, that dead people pay taxes. Everybody pay taxes, even in death. Okay. One purpose for the death benefit from a whole life policy and other forms of permanent insurance is to pay income taxes that becomes due on death. The use of insurance to cover tax liabilities at death allows the value of the estate to remain intact and not decrease by the taxes due. Okay? Such taxes apply to investment assets, non-principal residences such as a cottage, and to business shares or private companies. Okay? For example, Henry is 50 years old and he is in great health. He is widowed with one son, Jack, who is currently 14 years old. Henry and Gap enjoys the time they spend together at the cottage. And Henry would love or would like Jack to receive little to the property, to receive title to the property when he dies. When he dies, based on his family history, Henry believes he will live until at least age 90. Henry expects the value of the cottage to triple by the time he dies. And he's worried that there will not be enough money in his estate to pay the income tax on the taxable capital gain that will result from the deemed disposition of the cottage when he dies. He estimates that this tax liability could be 200,000 or even higher, depending on the real estate market. Henry would like to use life insurance to make sure that this risk is covered. However, he will not be able to get term insurance coverage that lasts until age 90 or beyond. A whole life policy will give him the protection he is looking for. Wow. For example, if he changes his mind about leaving the cottage to Jack, and he instead decided to sell the cottage before he dies, he can always keep the policy for other estate needs or surrender the policy and use the cash surrender value as he chooses. Eric is already 45 and he had not even considered life insurance until his recent marriage and the birth of his son, Oliver, last year. Eric's sedentary lifestyle has resulted in him being overweight with high blood pressure and the onset of type 2 diabetes. Wow. He was dismayed to learn how much the life insurance will cost because of his health, and even more dismayed to learn how much cheaper it would have been had he bought it when he was young and healthy. Oh, you see, this prompted him to purchase a whole life policy on Oliver's life so he will always have insurance protection. And when Oliver is an adult, Eric can transfer ownership of the policy to him with the added benefit that Oliver will be able to make out a policy loan against the cash surrender value if needed for his education or for the down payment of his own home. Wow. Future insurability. Yeah. Future insurability. Whole life insurance provides a lifetime guarantee insurance coverage at a fixed price as long as premiums are paid. If acquired when an individual is young or before health concerns arises, it can be more affordable than when acquired later in life and when health issues surface. As health deteriorates, one runs the risk of being uninsurable for new insurance coverage. Increasing coverage. Participating policy provides easy way for the amount of life insurance coverage to increase over time without the need to provide medical evidence or insurability. For example, Tony is 33 years old with a young family, and he would like to obtain life insurance coverage for 10 times his salary. His salary is 60,000, but he expects it to increase dramatically over the coming years. He would like his new insurance coverage to keep pace with the increase in his salary, preferably without increasing his premium. While Tony is currently in good health, I will have no trouble obtaining a life insurance. He knows that his father and his uncle both started experiencing significant health issues at age 40. So Tony is worried that if his health follows family history, he might be unable to buy additional coverage at affordable costs in the future. So a 600 participating whole life policy with a paid up addition option will be a good choice for Tony. Mhm. Now, the paid up addition will increase his coverage without increasing his premium and without requiring proof of insurability. If it turns out that the paid up addition adds more coverage that Tony needs, he may always use the additional coverage to address other estate needs or surrenders part of the policy and use the resulting cash surrender value for other purposes. Yeah. So let's talk about 10 to 100. 10 to 100. 10 to 100 insurance. So everything we've been discussing since is regarding whole life. Okay. So 10 to 100 is a pretty much straightforward. It's just like temporary insurance. It's just that you pay for it or you continue to pay, like if you have term insurance for 10 years, you pay for 10 years, 20 years. But if 10 for 100, you continue to pay until age 100. It's after age 100 that the policy is paid off. And when you live more than 100, you are still covered. You don't need to pay again after age 100. Now, this combines elements of term insurance and a permanent insurance. Now, duration of coverage, 10 to 100 provides a lifelong coverage. Some policies matures at age 100 and pay the death benefit when the life insured reaches age 100 or dies whichever comes first. Okay. Some policies only pay the death benefit when the life insured dies, but the premium ceases at age 100. Okay, that's what I just explained. Okay. Now, premiums for 10 to 100 policies. Premium ceases at age 100. After when you get to age 100, you don't pay premium again. Even in the death benefit has not yet been paid, or that is, even if the person has not died, you don't pay again. Now, premium cost is lower than whole life insurance and higher than the term for an equivalent amount of coverage. Because T100 policies do not accumulate cash value and do not provide for future benefit, automatic premium loans are not available to cover missed premium payments. Thus, a missed premium that is not paid by the policyholder within 30 days of grace period can lead to a lapse or cancellation of the policy. Some policies gives the policyholder the opportunity to reactivate their last policies within a set period of time, or a set period of missed premium must be paid, and the missed premium must be paid. Okay. Now, with the 10 to 100, because it doesn't build in cash surrender value. So if you missed your premium, you have 30 days grace to pay, otherwise the policy will lapse. And some insurance company will allow you to reactivate the policy within a certain window, maybe within 3 months or whatever. But when they do reactivate the policy, you are expected to pay all the missed premiums. Okay. Now, level cost of insurance. Excuse me. Most 10 to 100 policies charge a level premium for the duration of the policy, referred to as a level cost of insurance. Now, the level cost of insurance does not provide for the accumulation of any cash surrender value or other non-forfeiture benefit. Therefore, premiums are based on the attained age of the life insured at the policy's issue date. And the younger the life insured is at the time of the issue, the lower the premium for the life insurance. All right. Now, moving on to limited payment T100. Limited payment T100. Limited payment T100. Okay. All right. Like limited payment whole life, premium payment for T100 may be limited to a set number of years or to a set age. At the end of the period, the policy is then paid up. But because the premiums are paid up over a shorter period of time, the premium for a limited pay T100 are higher than that of a straight T100 policy. T100 policies that are limited payment have a cash surrender value. Its value can be received by the policyholder if he has no need for the policy. Now, the cash surrender value can also provide automatic premium loan, like whole life policies does. Okay, death benefits. Death benefits of T100. Death benefits. The death benefit is equal to the face amount of the policy. And is fixed for the contract duration. Okay? Upon age 100, what happens when the life insured reaches age 100 depends on the insurance company and the detail of the contract. Some policies specify that the death benefit will be paid to the beneficiary when the life insured turns 100. Other policies specify that the payment of the premium ceases at age 100, but the coverage continues until death. Availability from insurance. Now, for T100 policies, those without a cash surrender value and with premium payment payable up until age 100 are readily available from major insurance companies and other financial institutions. Limited paid up to 100 policies are no longer common in Canada, but are available in the United States. Using Term 100. Term 100 insurance may be appropriate when the following conditions apply. We are almost there, okay? 100 insurance may be appropriate when the following conditions apply. Number one, the policyholder acquires a fixed amount of insurance to cover a need that is not expected to increase prior to death, regardless of when that death might occur. The policyholder is certain that he will never want to surrender the policy. The policyholder has no need of the investment opportunities provided by the universal life insurance. For example, Trevor recently lost his wife after a long battle against cancer. He was overwhelmed by the support that the local hospital center provided to his wife, himself, and their children during the last 2 months before she died. Trevor is absolutely determined to donate 500,000 to the hospice center upon his own death. Trevor decided to buy a 500,000 P100 policy now. And while the premiums are still affordable, because this will ensure that he will be able to make that gift even if he lives to age 110. And depletes all of his own resources, he has no intention of ever canceling the policy. So he does not need a policy that builds up cash surrender. Yes, we made it. Ah, this is a very long chapter. Even me, I'm like, oh my God, oh my God. But thank you guys for sticking out to the end of chapter 3. And this brings us to chapter 3. And I think it's important that we take a break here, okay, and pause and review what we've read. Um, I'll continue on chapter 4, or better still, do practice quizzes for chapter 1, 2, 3, whichever one I decide to do. Thank you very much, and I hope this is giving you value. If it does, please leave a comment in the comment section. And your way of saying thank you is just by hitting that subscribe button, and we will really appreciate that. Thank you for your time, and I will see you in the next class for chapter 4. Have a good one and stuff. All right, welcome back to this class. And in this class, we are going to be taking chapter 3, chapter quizzes, and that is Q&A, more or less question and answer for chapter 3. If you have not yet watched the actual training class for chapter 3, I recommend you do so before coming to these questions and answers. So without further ado, let's jump right into the Q&A. And I was looking at chapter 3. Oh my goodness, lots of questions. It's actually 30 questions. So let's start. If you guys recollect, chapter 3 actually dealt mostly heavily on whole life insurance. Okay, so our question 1 says, how long does 100 coverage last? Yes, chapter 3 is whole life and just more or less permanent insurance, but whole life and 10 to 100. Again, if you haven't seen the actual training for the class, please go check it out now. How long does term insurance coverage last? 5 years? No. Sorry, how long does term 100 coverage last? Again, when you see term 100, it's a permanent insurance. It's not temporary, it's term to 100 years, okay? Is it 5 years? No. 85 years of age? No. For life, 200 is for life, okay? Yes, payment is up to age 100, but coverage is for life. Now, they are not asking us how long does payment last. They're asking us how long does the 100 coverage last. It lasts for life, I believe. But again, we are 29 questions from moment of truth. So let's keep going. Question number 2. What will the insurance company retain to boost policy reserves in case they experience a shortfall in revenue in the future? I think I remember we talked about this. Anyways, what are the options? Shortfalls, what do they retain? Surplus, participating premiums, I think it's surplus, right? Now, what would the insurance company retain? This, I'm just using my general kind of knowledge. Insurance company retain to boost the policy reserves in case they experience shortfall in that is a surplus. That is when they experience surplus, they retain those surplus for the future in case they experience revenue shortfalls in the future. So I'm gonna go with surplus, okay? And we move on to the next. Which insurance policy provides coverage for the entire life of the life insured, with a premium that typically remains level over the duration of the contract? whole life, term 100, full life, universal life. Which insurance policy provides coverage for the entire lifetime of the life insured? Whole life and term 100 does that with a premium that typically remains level over the duration of the contract. Level over the duration of the contract. For whole life and term 100, the policy is level, it doesn't go up, right? So I'm going to go with term 100. The reason is because with whole life, we can customize it to pay for a specific period of time. But again, we're going to see that later on in the answer and the rationale. Question number 4. Let's see. For term life insurance cash surrender value, what does the policy not build up? What does the policy not build up? So policy has no value upon expiry or termination. For term life insurance cash surrender value, term insurance cash surrender value. Term insurance doesn't have any cash surrender value. What does the policy not build up? So policy has no value upon expiry or termination. Renewability, increasing benefit, premium, cash value. The term insurance doesn't build up cash value. Again, this is one of those questions that even me as I'm reading it, it's not much requiring with whatever. Let's keep going. Question number 5. What traditional premium is sometimes referred to as a lifetime par policy? A lifetime pay policy. What traditional premium is sometimes referred to as a lifetime pay policy? A limited, long-term, single, ongoing. I think it's all ongoing. So when you see a pay policy, a lifetime pay policy, limited pay policy, these are a way of paying up whole life insurance. So when they are now telling us that what is a traditional premium is sometimes referred to as a lifetime pay policy. So if it's a lifetime pay policy, it means it's ongoing. The person has to pay as long as the person lives, right? So that's why I say it's ongoing. But if it's a single pay policy, the illustration is run if the person's premium is 50,000, the person paid once, that is a single pay. And then if it's a long-term policy, so again, if it's a long-term pay policy, now that I'm reading this, what is traditional premium is sometimes referred to as a lifetime pay. The fact that it's long-term doesn't mean that it will be lifetime. How long is long, right? And then limited is the one we use for the most of the time, where we specify, okay, 30 years pay, 20 years pay, and stuff like that. Okay. I'm going to go with ongoing, okay, because they use the word a life. What is a traditional premium is sometimes referred to, because they say it's a lifetime pay, I want to say it's ongoing. Okay. Next. Question number 6. Which insurance policy provides coverage for the entire lifetime of the life insured, but the policy matures at age 100? I even talked about it. That is 10 to 100, okay? The policy matures at age 100, but the coverage is for a lifetime, okay? So when we say coverage matures at age 100, it means premiums are done at age 100. So you pay until age 100, you don't pay again. But the coverage is for life. God blesses the person and the person lives more than 100 years, the person is still covered. Okay? Moving on to question number 7. What is usually levied against a policy's cash value to discourage a policy holder from cashing in his policy before they can recoup their expenses? Okay. Policy loan, no. Surrender charges, yes. No forfeiture costs, no. For future expenses, no. It's called surrender charges. So you see that these are the costs, these are the expenses that are associated with the policy. So you're going to see the accumulated fund in that policy, but the owners cannot access it. You see, like for some of our carriers, you see the accumulated fund and how much the person can withdraw. Even some companies is zero. You see money there, but the cash value is zero. So yes, that's what I'm going to say, surrender charges, okay? Not for future cost. Anyways, let's go on to question number 8. In the case of a term life insurance policy, which of the following is estimated by multiplying the policy's face amount by the insured probability of death during that year? Yeah, we saw this question in chapter 2. Guys, you remember? Right? Which would mortality cost, model factor, investment return expenses? I think it's mortality cost. Yes, mortality cost is the answer. I remember we saw it. We got it wrong then. You see the way these things are connected, right? So let's moving on. Question number 9. At the other extreme, it may be possible for the policyholder to pay what lump sum premium for life insured coverage that will last for the entire lifetime of the life insured. Yes. So that is called single, long-term, ongoing, limited. That is single. I just explained that like few questions ago, right? That is when you pay lump sum, run illustration, and your one-time premium is 50K, you drop that 50,000, your policy is paid up, and you don't need to pay anything again, and you have coverage for life. That is what this is talking about. It's called single pay. Let's read the question again now that I have explained it to you. It says, at the other extreme, it may be possible for the policyholder to pay what lump sum premium, that is a single lump sum premium for life insurance coverage that will last for the entire lifetime of the life insured. Yes. Okay. Let's move on. I think I want to have a sip of coffee. All right. Question number 10. Depending on which payment option the policyholder chooses, participating policy dividends may affect the following. A, premium reduction, cash, death benefit, and cash surrender value of policy, paid up addition. Everything they mention here have something good about participating. They say depending on which payment option the policyholder chooses. Participating policy dividend. Remember, per policy, a policy that pays dividend, right? So the dividend may affect premium reduction, cash, death benefit, and cash surrender value of the policy, paid up addition. So again, like, this is one of those questions that I would really love if Remy could reward them in a better way for understanding purposes. Because you're telling me, depending on which payment option the policyholder chooses, there are different payment options. Okay, yes. Then, yeah. Participating policy dividend may affect. Select one. We can use it to reduce premium, which is an option. We can collect it in form of cash. Can use it for paid up addition. And also, it can affect death benefits and cash surrender value of the policy. How can it affect death benefit? So they are not telling us which method of receiving the participating dividend. Say the policy dividend may affect. You know what? I'm going to go with this. The reason I'm going with death benefit is that if the part dividend is not withdrawn or utilized for premium reduction, in cash or paid up addition, it could affect the death benefit by increasing the death benefit. It can also affect the cash surrender value of the policy by increasing the cash surrender value. So that's the reason I'm going with that option. But we're going to see. Okay? Be patient. All right then. Which policy does not change over time, regardless of the insurance company's experience with mortality cost, expenses, and investment return? Which policy does it change? Single life, guaranteed whole life, limited, adjustable whole life. Which one doesn't change? Regardless. Regardless. Mm. Single life. That is single life, whole life policy. Policy on one life. Guaranteed whole life. I'm going to go with guaranteed whole life because they say which policy does not change over time, regardless of the life insurance company's experience with mortality costs and everything. Guaranteed everything. They've guaranteed you the returns, and that's what you get, irrespective of. Does not change. So I'm going to go with guarantee, but we'll see. All right. Question number 12. What do most Term 100 policies guarantee for premiums to remain for the duration of the contract? What do most Term 100 policies guarantee for premiums to remain for the sorry. You know what's happening to me as I'm reading the question, I'm reading the answer. And now there's traffic jam in my brain. Anyways, okay, let me calm down. Okay, what do most Term 100 policies guarantee for premiums to remain for the duration of the contract? A, increasing, low, level, decreasing is level. Term 100, the premium is leveled all through the period. Okay, it's not going up. Question 13. Which insurance policy provides coverage for the entire life of the life insured, but also includes a savings component that is created through the deposit of excess premium? Universal life, whole life, half life, Term 100. So universal life and whole life does this. So how do I know which insurance policy? Universal life and whole life are correct. So now let's look at the question again to see, all right, which insurance policies provides coverage for the entire life of the insured. Universal and whole life does, but it also includes a savings component that is created through the deposit of excess premium. A savings component that is created through this deposit of excess premium. A savings component. A savings component is not mentioning investment. A savings component, but also include a savings component that is created through the deposit of excess premium. Universal life and whole life has investment component, not a savings component. So for that reason, I'm going to opt for 10 to 100. Let's mark it down, question 13. Okay, guys? All right, move on to question 14, guys. Oh, this is a very short question, but the options for answers are lengthy. All right. Which one is not an advantage of whole life insurance? So we are looking for wrong answer here. A policyholder has little or no choice over how the policy reserves is invested. Yes, this is true. Okay, this is true of whole life. The policyholder has little or no choice over how the policy reserves is invested. Again, B, premiums are not guaranteed for life. Oh, this is not. This is premiums are guaranteed for life. So right off the bat, I'm going to be leaning towards which one is not an advantage of the whole life. I think premiums are not guaranteed for life. A whole life policy can lose its cash surrender value over time. Yes, coverage continues for life regardless of the age or health. Yes. So all these are advantages of whole life insurance, but premiums are not guaranteed for life. No. Whole life policy, premiums are guaranteed. Abi? Again, market number 14. Question 15. Which dividend payment option is also referred to as premium offset options? Okay, this one is talking about, especially for whole life, participating whole lives that pays dividend. So all these options are different ways, different methods of receiving your dividend if you have participating whole life. So now they are asking us which one is also referred to as premium offset options. Now we have premium reduction options, paid up addition options, accumulation options, and cash. I think it's paid up addition because no, premium offset options. No, it should be premium reduction by using it towards reducing your premium. Use it to offset your premium, right? It's premium reduction. Premium reduction. Paid up addition. All right, so let's go. Question 16. What is it called when the coverage is provided for life, but premiums are only payable for a limited number of years? It's limited now. the answer is in the question. Maximum pay basis, no. Short pay basis, no. Level pay basis, no. Limited pay basis. Okay? When premiums are payable for a limited number of years. It could be 10 years, 20 years, and thereabouts. Okay? All right. Question number 17. Which one is the correct dividend payment option? Sorry, which correct dividend payment option is used as a single premium to buy 1 year term insurance? That is premium reduction, no, term insurance, no, paid up addition. That is paid up addition. So you use your dividend to pay up. For example, if a 1-year term policy premium, annual premium for that 1-year policy is, let's say, $1,000, and your dividend is 1,000, you just use that 1,000 to pay up addition. That's what it's called, a single premium to buy a 1-year term policy. Okay. Awesome. Moving on to question number 18. What reflects the insurance company's loss of investment income compared to the income it could have earned on an annual basis? What reflects the insurance company's loss of investment income? Loss of investment income compared to the income it could have earned on an annual premium. Investment returns, model factor, mortality cost, or expenses. What reflects insurance company loss of investment income compared to the income it could have earned on an annual basis? Investment returns of investment income. Yeah. So I'm gonna go with investment returns, right? Because they're asking us what reflects the insurance company's loss of investment income. Loss of investment income. So that's investment returns compared to income it could have. Yeah, I'll go with investment returns. Okay. 19. What is the correct dividend payment option that the insurance company deposits the policy dividend in a side account? What is the correct dividend payment option where the insurance company deposit the policy dividend in a side account? Is it paid up addition? No. Premium reduction? No. Cash? No. Is accumulation. Is the way the dividend is being put in a side account and is building up there, it's called an accumulation. Okay. Awesome. Question 20. What is one of the benefits of whole life insurance that is at guaranteed fixed price? Half-life protection, lifetime protection, income taxes, increased coverage. What is one of the benefits of whole life insurance that is at guaranteed fixed price? I think it's lifetime protection that is at guaranteed fixed price. Income taxes, increased coverage, no. I'll say a lifetime protection, but we'll see. Question 21. When the insurance company's excess revenue are not needed for policy reserves, which whole life policy allows the insurance company to distribute some or the entire surplus as policy dividend to the participating policyholder? Oh, come on, the answer is right there now. It's participating. Okay, let's be sure it's oh, okay. Which policy allows the insurance company to distribute its participating whole life, my darling? And it is right there, but to the participating policyholder. It's participating. Oh, 22. What are used to sell these policies that are not meant to be guaranteed or performance? A, dividend scale. 2, disclosure. 3, whole life policies. And option D is illustrations. What are used to sell the policies that are not meant to be guarantees or guarantees of performance? I think it's illustrations, right? Because when we show people illustrations, What we show in illustration doesn't mean it is guaranteed of the performance, right? Disclosure, whole life policy disclosure, dividend scheme, what are used to sell. Okay, so I'm going to go with illustrations, but again, we'll see together when we are done. Question 23. As a matter of fact, we'll soon be done. This particular chapter 4, no, not chapter 4, chapter 3, have 30 questions. All right. What is the debt benefit of a T100 policy for the duration of the contract? Is it fixed? Is it not fixed? Is it decreasing? Is it increasing? It's fixed. The debt benefit is fixed. It doesn't decrease, it doesn't increase. It's not a non-fixed. 24. For whole life insurance renewability, whole life. The policy requires renewal and will remain in force even if the health of the life insured declines. Sometimes, rarely, never. Whole life doesn't renew. Right. Always, never, rarely, never. Whole life doesn't renew. But again, we'll see. For term life insurance investment, what would the policy not provide? For term life insurance investment, term life insurance investments, term life insurance doesn't provide investment. What would the policy not provide? One, A, dividend. B, a policy. C, guarantees. D, insurance. For term life insurance investment, what would the policy not provide? A policy, a guarantee, and insurance. I'm just going to go with dividend because term life insurance doesn't give any investment, no dividends or stuff like that. So we'll see about that. 26. Anyways, we are 4 questions away from moments of truth. All right. What whole life insurance policy provides lifelong insurance coverage while only requiring premiums for specified guaranteed period of time? What whole life insurance policy provides lifelong insurance coverage, yes, while only requiring premiums for a specified guaranteed period of time? Limited payment life, whole life, payment life, limited whole life. I think it's limited payment life. 27. Which insurance policy offers a death benefit and premium that the insurance company may adjust periodically to reflect its actual experience? Adjustable whole life, guaranteed whole life, single life, limited life is adjustable whole life. Okay. Whoa, this is some epistle. All right, question 28. Which of the following is not covered in premiums by term insurance? While the life insured is relatively young, the premiums are generally lower than premiums for the same amount of whole life coverage. That's true. That is true. B, premiums generally increase with the age of the life insured, not covered in premium by term insurance. As the life insured ages, the premiums eventually become higher than premiums for the same amount of whole life coverage and may eventually become cost prohibitive. Yes, that's true. So now I still have my thumbs up for B because something is not. Premiums generally remains constant regardless of the age of the life insured. So which of the following is not covered in premium by term insurance? Premium generally remain constant regardless of the age of the life insured. And B says premium generally increase with the age of the life insured. Which of the following? So now I think our answer should be between B and D. Which of the following is not covered in premiums by term insurance? Which is not covered in premiums? Premiums generally increase with the age of the life insured. Yes, premium increase, but at the end of the term is when it increases. Not just increase because, premiums generally remain constant regardless of the age of the life insured. Anyways, I'm going to go with my gut with this, and we'll see the answers later on. Which dividend payment option is normally paid annually? Which dividend payment option is normally paid annually? Cash, accumulation, premiums reduction, paid up addition. Which dividend payment option is normally paid annually? Cash, accumulation, premium reduction, paid up additions. I don't get it. Which dividend payment option is normally paid annually? I'm going to go with paid up addition, because if we say premium reduction, does it have to be annual? Accumulation and whatever. Anyways. 30. What is known to be one of the strongest arguments for whole life insurance that comes due upon death? A, increasing coverage. B, premiums. C, income tax. Future insurability. I believe it's income tax. Okay. Which is known to be one of the strongest arguments for whole life insurance that comes due upon death? Is income tax, premiums, no. Increasing coverage, no. Future. Okay, so if we've saved all our answers, and now let's see the moment of truth submit. Woo. Wow, we filled 1, 2, 3, 4, 5, 6, 7. So we scored 23. We scored 23 over 30. Okay. All right, so let's review. Wow. Question 1, we got that, which is for life. How long does the 100 last? Is for life. That is true, and the rationale is the 100 provides coverage for life. Question 2, we got that, again, is surplus, and the rationale is the insurance company retains some of this surplus to boost policy reserves in case they experience a shortfall in revenue in the future. Question 3, we didn't get the, oh my goodness. It said, which insurance policy provide coverage for the entire lifetime of the insured, of the life insured? Okay. With a premium that typically remains level over the duration of the contract. Oh. Okay, the correct answer is whole life. Yeah, because then 100, you don't pay. See the rationale, it said whole life insurance provide coverage for the entire lifetime of the life insured with a premium that is typically leveled over the duration of the contract, which could be, 10 years, 20 years, depending on the contract. Okay, okay. Wow, this is interesting. And you see why sometimes even when you know some of these things, it could just throw you off, you know? All right. Questions 4, we got that one. And the answer is cash value. Rationale is policy does not build up cash value, so policy has no value upon expiration or termination. Question 5, we got that one. Is ongoing. Okay. The traditional option, the traditional option involves paying a fixed premium for a duration of the contract, that is until the life insured dies or the policyholder surrenders the policy. So this is sometimes referred to as the lifetime pay policy. All right. So even the one we got the answer, I'm still reviewing it so that in case you don't understand the principles, you understand. Question 6 says, which insurance policy provides coverage for the entire lifetime of the life insured is then 100, but the policy matures at age 100. So now the policy matured at age 100 T100, which is known for the most popularly known as T100 life insurance, also provide coverage for the entire life of the life insured, but the policy matures at age 100, such that premiums are no longer payable. After age 100, no premium is payable, but coverage is there for life. All right. Okay. The next one, we got it too, which is usually levied against policy cash value. It is the surrender charges. And here we have the rationale says that as a result, they usually levy surrender charges against a policy cash value, so to discourage a policyholder from surrendering or cashing in on his policy before the insurance company recoups their expenses. Okay. 8 is mortality cost. All right, and there is the rationale. Sorry, I'm just going to fly through this because there are 30 questions. We've already seen the questions, so mortality cost and the rationale is that in the case of a term life insurance policy, the annual mortality cost of the policy is estimated by multiplying the policy's face amount by the insured probability of death during that year. So remember, when we get into the calculation part of it, they are going to give you the annual premium, and then they'll give you the mortality, um, what is it called? The probability of death, and they'll give you the probability of death to do the multiplications. Okay. Question 9, we got that one too. At the other extreme, it may be possible for the policyholder to pay what lump sum premium for the insurance coverage that will last for the entire lifetime of the life insured is a single pay. You see, a single pay. At the other extreme, it may be possible for the policyholder to pay a single lump sum payment in premium for the insurance coverage that will last a whole lifetime. Okay, we move on to question number 10. Depending on which payment option the policyholder chooses, participating dividend may affect this one. Oh my God. Yeah, dividend may affect the benefit and cash surrender value. You guys remember we were like, I was saying, I'm going to go with this C because, okay, I'm curious to see their rationale. Depending on which payment option the policyholder chooses, participating policy dividend may affect the death benefit and the cash surrender value, including any additions. Interesting. Okay, awesome. Question 11. Which policy does not change over time, regardless of the insurance company's experience with mortality, cost, expenses, and investment returns is a guarantee whole life. Yeah. Guarantee whole life does not. Okay. Now, here is our rationale. A guarantee whole life insurance policy offers a death benefits and premiums that are guaranteed not to change over time, regardless of the insurance company's experience with mortality rates or whatever. So guarantee whole life, is the answer. And we got that. Question number 12. What do most D100 policies guaranteed for the premium to remain for the duration of the contract is leveled, is guaranteed leveled premium. All right. Even in the rationale, you see that D100 policy guaranteed that the premium will remain level for the duration of the contract up until age 100. Okay. I think we didn't get this one. Remember, I even asked us to mark it down, right? Okay, so let's look at it. Which insurance policy provides coverage for the entire lifetime of the life insured? But it also includes a saving component that created through deposit excess. So they say the answer is universal life. So we have not dealt with universal life yet. Universal life is in chapter 4. Why are you testing it in chapter 3? Anyways, now you know, because in chapter 4, we will be dealing with universal life. Okay, so again, look at the rationale. A universal life insurance provides coverage for the entire lifetime of the life insured, but it also includes a savings component that is created through the deposit of excess premium. Anyways, moving on to 14. We didn't get it to. Which one is not an advantage of whole life insurance? Okay, which one is not? Say the answer is policyholder has little or no choice over how the policy reserve is invested. It's not an advantage. Let's look at the rationale. They are telling us that they are looking for disadvantages of, okay, when they say it's not an advantage, so in other words, they are looking for disadvantage inversely of whole life, the high initial cost in the early years of the policy, and the premium for the whole life insurance will be higher than those of the same amount of term insurance, which may make it cost prohibitive for people with limited cash flow, of course. Okay, let's read this, all right? We say that policyholder has little or no choice over how the policy reserve is invested or the policy for participating whole life policies. Policy dividends are not guaranteed. Yes, even a small change in the dividend scale can significantly alter the long-term performance result. There is a theory that suggests buying term insurance and investing the difference may result in a better financial outcome, provided the policyholder is disciplined to invest the difference. The way the policy reserves is invested and managed is not entirely transparent to the public. Okay. Question 15, we got that one. Which dividend payment option is also referred to as a premium offset option? Is a premium reduction. We got that one. Okay. I'm going to fly through this now. Okay. Question 16. What is it called when the coverage is provided for life, but premiums is only payable to a limited number? That is limited pay basis. Limited pay. And the rationale is that T100 policies can also be issued on a limited pay basis, meaning that coverage is provided for life, but premiums are paid only for a limited number of years. All right. 17, we did not get this one. The question is, which correct dividend payment option is used as a single premium to buy 1 year term? I thought it's paid up addition. They say no, it's term insurance. Oh. Rationale under the term insurance option, the annual policy dividend is used as a single premium to buy 1 year term insurance. Okay. Question 18. We didn't get that. What reflects the insurance company's loss of investment income compared to the income it could have earned? We investment return, but the same is model factor. Oh, really? Okay, rationale is that the insurance company calculates the periodic premium payment by applying a model factor that reflects the insurance company's loss of investment income compared to the income it could have earned on an annual premium. Wow. Is the pressure getting worse? All right. 19. What is the correct dividend payment option? No, that is the one we just did, right? Okay, no. What is a correct dividend payment option that the insurance company deposits the policy dividend? This one is accumulation. The rationale is that if the policyholder chooses the option, the insurance company would deposit the policy dividend into a separate accumulation account, also known as a side account, which is invested to provide additional growth. Okay. Question number 20. Yeah, we got that one. The question is, what is one of the benefits of whole life insurance that is at guaranteed fixed price, that is lifetime protection? And the rationale is that one of the benefits of whole life insurance is that it can provide lifetime protection at a guaranteed fixed price. 21. When the insurance company's excess revenues are not needed for policy reserves, which whole life policy allows the insurance company to provide or distribute? This is the one I was telling you guys that even the answer is right in the question, which is participating whole life. Okay, and here is the rationale. When participating or par whole life insurance policy generates excess revenue, the insurance company will still use some, oops, this popped up, or excess of the policy reserve to reserves at the level required by the provincial insurance regulators. However, to the extent that the excess revenues are not needed for the policy reserves, the insurance company may distribute some or the entire surplus as policy dividend to the participating policy holders. Okay, 22. We also got this one, which is illustration. Say what are used to sell? It is the word sell that makes me wonder, to sell policies, that are not meant to be guaranteed. Of course, the illustration we show in the the performance we show in the illustrations are not guaranteed, right? And the rationale is here, the illustration used to sell these policies were not meant to be guaranteed of performance. That's so true. 23. What is the death benefit of T100 policy for the duration of the contract? It's fixed. The death benefit doesn't increase. It doesn't increase either, okay? And that's why in the rationale, we see here that the death benefit of a T100 policy is fixed for the duration of the contract. 24. For the whole life insurance renewability, the policy requires renewal and will remain in force even if the health deteriorates. Never. Whole life never doesn't renew. You have it for life. You see? Here, look at the rationale. Policy never requires renewal and will remain in force even if the health of the life insured deteriorates. You got it? You got it. You got it. Got it. You got it. All right, moving on to 23. Okay. For term insurance investments, what would the policy not provide? It doesn't provide dividend. Term insurance doesn't have investments, right? So rational policy will not provide dividend. Never have, never will. 26. Whole life insurance policy provides lifelong insurance coverage while only requires premium for a specified guaranteed period of time. That is limited payment life, okay? So let's see our, oh my eyes. I think I've stayed at the computer for so long, almost 3 hours now or more, okay? Rationale is that limited payment life is a whole life insurance policy that provides lifelong insurance coverage. Why only requires premiums for a specified guaranteed period of time? That is limited payment life, okay? 27, we are almost there. All right, 27. Which insurance policy offers a death benefit and premium that the insurance company may adjust periodically to require or reflect its actual experience? Is adjustable whole life. And the rationale is this. In contrast, an adjustable whole life insurance policy offers a death benefit and premiums that the insurance company may adjust periodically to reflect its actual experience. Okay. 28. Which of the following is not covered in premiums by term insurance? Yes, this is that long one, right? So let's go into the correct answer is premium generally remain constant regardless of the age of the life insurance. Okay, so I was saying the answer is between this and this. Okay, I'm curious. The rationale is that premium generally remain constant regardless of the age of the life insured. While the life insured is relatively young, premiums are generally higher than. Okay, okay. Anyways, 29. I see that they're just repeating in their rationale, they're just repeating the options they put in the option A and option C. So that's why I'm not just going through to read it line by line. All right, 29. Which dividend payment option is normally paid annually? Yeah, for this one, I struggle because I'm not sure. And then the correct answer is cash. Dividends are normally paid annually. Okay. So how do you know it's I was going to say, why cash? Because policyholder could choose a different method of receiving their dividend, right? Anyways, the last question. We got this one. What is known to be one of the strongest arguments for whole life insurance that comes due upon death? It is income tax, guys. And the rationale is that probably one of the strongest arguments for whole life insurance revolves around managing the income taxes that comes due upon death. And that brings us to the end of the questions and answers for chapter 3. So, yes, so now you have it. We've done Q&A for chapter 3, and our next class we will be moving on to chapter 4. Thank you very much. If you find this class and this training very valuable, please leave a comment in the comment section. And if you're yet to subscribe, please, you want to consider doing so. Thank you very much, and I will see you in our next class. Have a good one.